The differences between VOOG and VOOV lie in the indices they track. VOOG tracks the S&P 500 Growth Index, which identifies growth stocks by analyzing the ratio of earnings change to price, sales growth, and momentum, representing the fastest-growing companies in the S&P 500, with a current weighting towards the tech industry. In contrast, VOOV tracks the S&P 500 Value Index, comprising the strongest S&P 500 value stocks, using a style attractiveness weighing scheme, resulting in a narrower focus than the growth index. As a result, VOOG tracks growth stocks in the S&P 500, while VOOV tracks value stocks. In terms of dividend yield, VOOV has a higher dividend yield compared to VOOG, attributed to its focus on value stocks. Value stocks, often underpriced due to negative perception or poor earnings reports, typically have a history of paying dividends. In contrast, growth stocks rarely pay dividends, as companies issuing these stocks reinvest their earnings into growth, resulting in higher earnings but lower dividends. Investors in growth stocks make money through capital gains after selling their shares, making VOOV a more appealing option for those seeking a stable income source. VOOG has a higher volatility of 5.73% compared to VOOV's 3.06%, indicating that VOOG's prices fluctuate more frequently and with higher margins, making it riskier. VOOV's prices are less volatile, making it ideal for risk-averse investors. Despite their differences, both ETFs track the S&P 500, have similar expense ratios, and are housed within the Vanguard S&P 500 ETF. They are also both passively managed, aiming to replicate the underlying index's performance. Ultimately, the choice between VOOG and VOOV depends on individual investment goals. For those seeking secondary income sources, VOOV's dividend payout, lower fees, and higher stability make it a more attractive option.